Changing jobs can create confusion in your life, such as a new commute, new coworkers, and new responsibilities. A job change also presents challenges related to financial management. One aspect of this is deciding what to do with your 401k or other defined contribution plan, but this process can be easy once you know your options. Today, I'll tell you about these options and give you the information you need to implement your decision. I'll also talk to you briefly about ways you can better manage your retirement investments. Keep in mind that the decisions you make now will have a significant impact on your financial security later. Once you leave a job, you have 4 choices as what to do with your retirement plan. The option you choose should be determined by your specific needs and goals. But the option many people choose is often the second one, to leave their assets in their former employer's plan. This often occurs not as a result of a well thought out strategy, but because it's the easiest thing to do. However, your retirement is too important to make decisions the easy way. The information I provide you today will help you make the right choice. Before we look at your options, let's take a moment and understand the larger factors that you should consider. First, taking a cash distribution from a retirement plan will likely result in federal and state tax. Second, if you remove any money from the plan before you're 59 and a half, you'll probably be subject to an early withdrawal penalty. Third, if your goal is long-term growth, allowing your money to grow tax-deferred will have a significant impact over time, and we'll discuss this shortly. And finally, you will want to make sure that the option you choose will allow you flexibility to invest the way you want to. Now let's talk about the choices you have available to you. The first of these is to withdraw the money from a retirement plan altogether. The benefit of this approach is obvious. You have immediate access to what could be a substantial amount of cash, and you can spend it however you like. However, there will probably be a significant cost of taking a lump sum distribution. First, in most cases, you will trigger a federal and state tax liability, and 20% of the proceeds will be withheld to pay these taxes. In addition, you will pay a penalty worth 10% of your assets if you make a withdrawal when you're under the age of 59 and a half. You will also lose the advantage of tax-deferred growth. Once you take money out of a plan, any further investment gains you make will be taxable. But if you leave the money in a retirement account, you will not have to pay taxes until you begin to withdraw the money. Over a period of many years, this is a difference that can really add up. How much can it add up? Consider this chart. It shows the value of $10,000 invested for 30 years at an average annual return of 8%, not reflecting the inherent cost of investing. Both tax-deferred and on a fully taxable basis, assuming a combined federal and state tax rate of 33%. Under this scenario, the tax-deferred account is worth over $100,000 at the end of 30 years, while the taxable account is worth less than half as much. Obviously, this is a point that should be considered carefully by those thinking of taking a lump sum distribution. There can be advantages to taking this approach, as long as it's part of a well thought out plan. If your current investments are performing well and you do not want to take the time to move the money into a new employer-sponsored plan, this might be the right course of action for you. Also, your previous plan may have advantages that your new plan may not, such as a better investment options or the ability to borrow against your retirement assets. What's more, your account maintains its tax-deferred status, which wouldn't be the case if you elected to take a lump sum. One important reason why you may not wish to keep your old plan is that since your contributions come directly out of your company retirement plan, you will no longer be able to add to your previous account. In addition, you may find that choosing another of your 4 options will allow you greater flexibility than you had under your old plan. First, what do we mean by the term rollover? Very simply, it's the movement of eligible retirement plan assets from one tax-deferred retirement savings vehicle to another. In most cases, you will be able to roll over all or part of your vested plan balance to your new employer's plan. This can be accomplished very easily, usually just by contacting your Human Resources Department and filling out the appropriate paperwork. When you roll assets from one employer plan to another, you do not have to pay either current income taxes or the 10% penalty, because you're simply changing accounts and not removing the money from under the retirement umbrella. As a result, you will enjoy the same tax-deferred benefits in the new plan as you did in your old plan. In addition, you'll be able to keep your assets in one account rather than having to manage multiple accounts. As was the case under the second option, keeping your assets in your previous employer's plan, you will want to consider the difference between the old plan and the new plan. Does one offer more flexibility, such as the ability to take loans against the balance? Also, does one plan offer investments with a better track record, or that are more suited to your needs? Even if your new plan offers a stronger selection of investment vehicles, you'll still be limited to that particular menu of investment options. This option probably gives you more flexibility than the other three we have already talked about. When you roll money out of your retirement plan into an IRA, you simply select the financial institution that will receive your assets. Then you can choose how your money will be invested. For those seeking guidance, many institutions will offer you professional assistance in selecting your investments. By choosing a rollover IRA, you get the same benefits of tax-deferred growth as you would with your company sponsor plan. You will not have to pay any taxes right away, and you will not be liable for the 10% penalty. In addition, you will not be constrained by the often limited choices offered through the company sponsor retirement plans. Instead, you can invest anywhere, in stocks, bonds, mutual funds, bank CDs, or even special asset allocation vehicles offered through a brokerage account. It is helpful to know that there are two ways you can execute a rollover. The first is the direct rollover, which occurs when your plan sponsor makes a check directly payable to the financial institution that is serving as a custodian for the new IRA. A direct rollover can normally be accomplished by completing a simple release form provided by your previous employer, as well as a brief application from the new IRA custodian. With an indirect rollover, the distribution is paid directly to you, but 20% is withheld for federal taxes. If you reinvest the assets in a rollover IRA or another employer-sponsored plan, you will retain the tax-deferred status. However, you will only be able to reinvest 80% of your retirement assets. The rest will be counted as taxable income for that year. This chart helps pull together the various features of your four options. As you can see, the lump sum distribution has only two advantages, but has many disadvantages, unless you absolutely need the money right away. On the other end of the chart, you can see that for those of whom the loan option and bankruptcy features are not important, the rollover IRA has the same positive features as a company retirement plan, but with a much wider range of investment options. Since changing jobs is so common today, and you may find that you have retirement money with a number of former employers and financial providers, if this describes your situation, you have the opportunity to greatly simplify matters by consolidating your retirement assets with one provider or even one account. This way, you have only one point of contact. You'll find it easier to monitor your investments, and you'll have less paperwork. If you already have an IRA, you can even move assets from your previous employer's retirement plan into that account. You may, however, want to set up a new IRA rollover account rather than commingling assets. This will just give you more flexibility and will simplify your taxes later in life. Once you have decided between your four options, you will need to determine how you will invest your retirement funds. There are a number of factors that go into choosing an appropriate investment mix that matches your particular goals and situation. These include your investment horizon, which may be largely a function of your age and the length of time you have until retirement, your ability to tolerate risk and ride out fluctuations in the value of your portfolio is a critical factor, and your overall financial profile, which provides an objective measure of how much risk you can afford to take. Sorting through all of these considerations may be confusing, but you don't have to go it alone. If you opt for a rollover IRA, a financial advisor can help you sort through these considerations and put together a portfolio that addresses your particular circumstances and can monitor it for you over time to make sure that it continues to meet your objectives. Remember, it's never too early to start planning for retirement. The sooner you begin working with a financial advisor to help secure your future, the better your chances for a comfortable retirement. I'm happy to take your questions on rollovers and other issues pertaining to retirement investing.